investing in real estate isn't all that it's cracked out to be. This was a very interesting article that I just read in MarketWatch, which is a publication that's done by the Dow Jones. And these guys, looking at the US residential market, have gone back to history all the way back to multiple hundreds of years. And they looked at actually the research to look at what's going on with the residential real estate market in the United States as far as rentals are concerned. So they're looking at rental properties because they're looking at capital gains as well as looking at what's going on with the rental income. So they've done their research, and their conclusion, their findings are really accurate with what I see in our Montreal market as well. So I want to share this with you because this is an excellent paper, and I will link it below as well. So those who want to read it, actually, I'll link it below in the links. So the authors, basically what they've done is their names are Mark Halbert, and what they've done is basically they've gone back, and what he said is that they've done a study based on real estate performance indices that were constructed by analyzing over 2.7 million real estate listings in 30 cities across the US. They looked at basically newspapers and have gone as far back as to 1890. Imagine, to 1890. And what they've done is they've compared this to the Shiller index, which is basically, and they've said that the Case-Shiller home price index isn't really as accurate as this way was done. Reason being is because they said that the Case-Shiller index goes on a single retrospective survey from the 1890 to 1934 period, and it looks at truncated loan data from 1953 to 1974. It means that they're not taking Case-Shiller as accurately as they would like. So they're saying this study is better than what Case-Shiller gives. And what they've done is basically, they said, looking at all this data, rental income is more important than capital gains. And this really is very accurate with what we see also in our Montreal market. And I'll go again a bit more in detail with what they've done here. They said that basically, if we look at post the 1980 period. So of course, what happened in 1980 is look at the 10-year charts for the interest rates. 1980 until 2022, interest rates went straight down. So obviously, as interest rates went down, obviously property values went up because cap rates really for any kind of rental properties went down as well. So what they say is that for the period from 1980, post 1980 period, this was a high sustained capital gains. As rates went down, then property values went up when cap rates went down as well. So this was a period, they said, which was high capital gains. And this is, they said, somewhat of an anomaly from a historical perspective. What they're saying is that the arithmetic average return for the US residential real estate was 10.9% from 1890 to 2006. So from 1890 to 2006, okay, the arithmetic average return for the US residential real estate was 10.9%. And of this 10.9%, 7.2% was coming from rental returns, and 3.8% was coming from capital gains. That means almost 2/3 of his returns were coming from the rental returns and not from the capital gains, which does make a lot of sense because obviously as your rental income goes higher, then your property value goes higher as well. So this really does make sense. And also what they said is that as well, second conclusion they made in this paper, they said residential real estate is not less volatile than equities. They said that why does residential real estate appear to be significantly less volatile than equities? They're calling this, they said the new study solves this puzzle by finding that residential real estate's apparently low volatility is only a mirage. And why are they saying this? This is very interesting. Is they're saying that basically the national housing price index's low volatility was the result of averaging these different cities' particular indices, which was individually very volatile. But I said was once we do an average of all these indices, then by averaging them together, then this gives the volatility being smoothed out. So what they're saying is that for them, the bottom line is what? They're saying we need to revise our beliefs about residential real estate as an asset class. It is significantly riskier, they're saying, than previously thought. Very interesting. And its long-term return has been far more reliant on rental income than capital gains. And this is really accurate. If you look at what Mr. Mark Halbert has written in his conclusion, it's the exact same thing also in our Greater Montreal market. If I look at, I'm focusing really on apartments because our niche market is apartments. But if you look at what's going on with the apartment market, is that from 1980 to 2022, as interest rates went down, then automatically the property values went up. And of course, then because interest rates went down meant that cap rates went down. And of course, if we look at what's going on the last couple of years, right now, the properties that are really increasing value are those that are increasing their rental income and they are increasing their rents, because as the rents go up, then automatically the NOI or the net operating income goes up as well. Then the property value goes up as well. To conclude, this paper is going to be accurate, of course, for the US market, but to look at this for our Montreal market, for apartments, it's the exact same idea as well. Focus on the rental income. As the property's rental income goes higher, automatically the property value goes higher. Automatically it's going to be a better return for the investor.